Today, we're looking at a surprising twist for the world's most talked about electric car company, Tesla Incorporated. The company reported a 37% decline in net income in the third quarter, even as revenues rose. Here's what happened. Tesla posted about $1.4 billion in profit for the quarter ended September 30th, down from about $2.2 billion a year earlier. At the same time, the company's revenue climbed, partly because buyers rushed to take advantage of a $7,500 U.S. federal EV tax credit before it expired. So, why did profits fall when sales were up? One key reason: Tesla cut prices to boost volume and offered more low interest loans and incentives. That strategy drove more unit sales, but at lower profit margins per vehicle. Analysts report Tesla's gross margin slipped to about 18%, down from much higher years prior. Another factor: increased costs. Tesla faces rising raw material prices, tariffs, logistics pressures, and a more competitive EV market than ever. Combined, these headwinds eroded profitability even as the top line number improved. CEO Elon Musk used the earnings call to shift focus. Tesla is placing growing emphasis on its robo-taxi service, AI developments, and the Optimus humanoid robot instead of just selling cars. He argued that vehicle sales are only part of Tesla's future. Let's step back and look at what this means for Tesla, the EV industry, and buyers. In the early years, Tesla enjoyed high margins because it priced its cars at a premium, offered something unique, and faced limited direct competition. As competition has grown, and as Tesla began chasing volume in order to scale up its global footprint, the business model is shifting. Price cuts and easier financing help stimulate demand, but they eat into profit. For buyers, this cut in margins might seem like a win: lower prices and better lease loan rates. But for Tesla's longer term health, margin erosion raises questions. Can it sustain investment in innovation, maintain profitability, and weather the intensifying competitive field? For the EV market overall, this result is a cautionary tale. Volume is important, but so is margin. Is The most successful manufacturers will need to balance competitive pricing with cost control and technology leadership. Tesla's margin squeeze highlights how much harder the industry has become. What might come next? Analysts will be watching. Can Tesla stabilize margins? Will it introduce truly lower cost models that still deliver profitability? How will competitors respond? And how will the broader economy, interest rates, subsidies, supply chains impact future results? If Tesla can navigate this phase and maintain its lead in innovation, it could come out stronger. But for now, this 37% profit drop amid rising sales is a clear signal that the journey ahead will be more difficult than many early believers expected. We follow breaking news, so follow us and subscribe to stay current.